Good day, everybody. Today is the 27th of April. It is 1:07 East Standard Time. Just wanted to go through three articles. They're get more and more difficult to find because of all the paywalls on this mainstream media stuff. So, anyways, I found one, BNN Bloomberg.ca. That's the Canadian that I have access to. So this is an article from BNN Bloomberg.ca. And this is the headline: Top hedge fund says violent emerging market sell-off is coming. Um, so they beat nine. So this particular, oh yeah, this is a big hedge fund. This is Man Group. They're really big. They beat 99% of its peers last year with a bearish stance on emerging markets, saying the sell-off since February has proven its skepticism right, and risky assets will face bigger losses. Man Group uh, prediction proved correct with a sell-off between October and January, uh, with sovereign dollar bonds from emerging markets handing investors a 2.2% loss than the benchmark MSCI Emerging Market Equity Index falling almost 7%. All right, so here's the quote. Our argument is still pretty much in play. We have one of the most defensive positions we ever had. Okay, that's Gilmore Ossis, head of the emerging debt strategy. So let me repeat that. We have one of the most defensive positions we ever had. Okay, so there's temporary rallies earlier this year, simply a consequence of the dollar liquidity dynamic, spillover from the collapse of the SVB. Bearish contracts with other Wall Street firms include BlackRock, asset management units of Morgan Stanley, JP Morgan, and have recommended investing more money in emerging markets. Even Goldman Sachs said they had a positive view on EM currencies. I would kind of agree and not agree. The strong currencies I'm seeing is British pound and somewhat euro as well. I did see a short I would have considered today on a shorting Japanese yen ETF, but it's just too spotty in terms of price action, so I just didn't take that. So for the reopening of the Chinese economy, weaker dollar and easing inflation expectation around the world hasn't translated any kind of return that bullish emerging market debt and equity investors expect. MSCI, that's the standard emerging market, has underperformed the S&P with gains of 1.5% and 5.6%. If you were over on my TradingView account at Brian Downing QLN, you will see some. There was an SPX one I did, and it was pretty evident that the Germany, the DAX was outperforming the US. Um, all right, so let's see. There now he's saying there's a liquidity drain next to 6 to 8, 9 months will prove starkly different, predicting a liquidity drain as the Federal Reserve continues to tighten monetary policy as the US Treasury cash balance increases. Something that should happen if and when the debt ceiling impasse is firmly resolved. And they'll take it right to the brink with that debt ceiling debate. It's always like that. Typical politician, right? With raising rates, Fed has been working over the past year to reduce the size of balance sheet by letting some of the maturing bond holdings roll off, process known as quantitative tightening. Uptick in emergency lending to banks has this year has reversed part of the balance sheet shrinkage, but that effect is fading as facility use diminishes. As far as I know, they're still talking about. There's one. Was it Pac West? I think is could blow up. But we shall wait it out, I guess. The Fed bond pile is shrinking by about 95 billion a month, equates to about 1.1 trillion, a tightening a year if the central bank keeps it at something could do, even if it hits pause on interest rates, which is most likely going to happen. Impact will only be compounded by a rebound of Treasury cash balance in the heels of a debt cap solution. So he's not the only one ringing the bells. Rally in the market over the past few months is largely driven by liquidity conditions. This is Olga Yangle from Credit Agricole SA in New York. We expect, excuse me, we expect the resolution of the debt ceiling and past the onset of the cyclical credit crunch, as well as potentially higher for longer Fed fund rate in the context of inflation persisting to send this in reverse. For that reason, we are underweight EM FX risk versus the dollar in our EM FX portfolio. Very interesting. Um, Widening in bond spreads in emerging markets is going to be much more violent than one that we saw in early 2022 when Russia invaded Ukraine. Uh, Emerging market debt lost 50% that year, its biggest annual loss since at least 1994. Wow. And when you look at what we expect to happen in 6 to 9 months from a risk reward perspective, it's very hard to have significant exposure because everything is going to play uh, against risk. Okay, so this is something about Japan. Additional challenges posed by Japan's central bank, which may relax its government bond yield control, reducing demand from the country's institutional investors for emerging market debt. Markets in distressed countries in Africa, East, South Asia represent the risks facing emerging market investors because lower quality credit has already been cut off from international borrowing and prices reflect that. That's according to this Ossus guy. As this liquidity drain deepens, uh, the situation is becoming more and more challenging, he said, particularly for any developing nation policy maker who operate as the liquidity they've become accustomed to over the past year will be still available. We think there's still release, and this is about to change quite abruptly, and that is changing quickly. We got other articles here. So this is now the U.S. Um, okay, this is from APnews.com. U.S. economy grew at weak 1.1 rate in Q1 in sign of slowdown. So they're only the March decelerating to just 1.1. That's the U.S. economy as higher interest rates hammered the housing market and business reduced their inventory. Funny enough, I saw some reports saying that it was like 4 weeks now of new applications coming in for new housing loans. Commerce Department showed that nation's domestic gross domestic GDP product, the broadest gauge of economic output, weakened after growing 3.2 from July through September and 2.6 from October to December. Consumer spending accounts for 70% of the U.S. economy, remain resilient. That's definitely going to slow down. I've heard that they are saying it could slow down by the end of this year as people start losing more and more jobs. And I think the things like Chat GPT is going to have a huge impact as well. Um, so it had a growing rate of 3.7%. So spending on goods, particularly, was solid. It rose at its fastest pace since the second quarter of 2021. Economists expect GDP to grow at 1.9% in January. Much of the January with a sharp reduction in business inventory, subtracted roughly 2 3 percentage points from overall growth. Companies typically slash their inventories when they anticipate a coming turn down. Uh, Economy slowdown reflects the impact of the Federal Reserve aggressive drive to tame inflation with 9 interest rates over the past year. Surge in borrowing is expected to send the economy into recession sometime this year. I think there will be deflationary as companies will need to reduce their product price in order to drive up demand as people are basically struggling with cash flow as things go up. Inflation steadily eased from the four-decade highs it reached last year, and they always have the Fed target at 2%. I could go on and on and on about that, but you get the idea. I'm just looking through it fairly quickly. Cooling enough to curb inflation, not yet, not so much as send the world's largest economy tumbling into recession. I think it's going to happen. Widespread skepticism that the Fed will succeed. Economic model used by the Conference Board, a business research group, puts the probability of U.S. recession next year at, wow, 99%. Conference Board recession probability gauge has hung around zero from September 2020 up until March 2022 when the Fed started raising rates to fight inflation. The GDP report was first of three estimates from the Commerce Department will make growth in January to March quarter. Economists expect growth to further weaken to just 3%. Latest survey said, and on it goes. I've got one last article here from the Guardian.com. Annual decelerates. U.S. economic growth slows sharply as interest rates hike back in. There, of course, a lot of these mainstream never talk about the debt. They never talk about that because that will spook the market. But let's face it, this could be a severe recession coming up. I hope you're prepared for it. Um, yeah, so right here, resiliency in consumer spending rose to 3.7, reflected in goods and services as business investment in equipment recorded the biggest drop since the start of 2020. Inventories dropped in most recent years. As I'll put this in my blog, the links, you can read them yourself. Um, yeah, I mean, there's not a lot positive coming out of this. I mean, I don't know. I've got my other opinions on things. The market, there are some sectors in the market that are doing okay, but most stocks are not doing too good. Either too volatile or just downward moving. There's very little trend in the market among a lot of stocks out there that I've done my scans. I just did one last night of 19,000, and I'm currently doing another one of different sectors, just looking for anything that may move and has strong growth. Anyways, we'll talk to you later. And if you want to know more, go over to quantlabs.net/books, get some free stuff, including some secret text tools that I'm using. And also get more and more into trading view. Yeah, there's some really cool stuff happening there too. Thanks. We shall talk to you later and have a good day.